In every major crisis, there is a pattern that rarely gets discussed. The first people to exit are often not the uninformed. They are not reckless. They are not the emotional crowd. They are frequently the most analytical people in the room. The ones who read balance sheets, who monitor liquidity spreads, who see structural cracks before headlines catch up. They recognize weakness early. And because they recognize it early, they act early. This is not incompetence. It is structure. Take 2008. From peak to trough, the S&P 500 fell approximately 57%. But no one experienced that decline as a straight line. Between October 2007 and March 2009, there were multiple rallies exceeding 10%. In November 2008 alone, the market rose nearly 19% within weeks. Each rally posed the same question: is this the bottom, or just another trap? Intelligent investors did not sell because they misunderstood the system. They sold because their models indicated that systemic damage was not yet fully priced in. And fundamentally, they were correct. The financial system was breaking internally. But markets do not recover when risk disappears. They recover when collective fear peaks. And peak fear does not appear in spreadsheets.
Most people believe they can tolerate losses. What they cannot tolerate is not knowing how long the loss will last. A 20% decline over 3 days feels violent but survivable. A 20% decline over 8 months becomes existential. Neuroscience helps explain this. Prolonged uncertainty activates regions of the brain associated with physical pain. Holding a losing position during extended crisis is processed neurologically like chronic discomfort, and the natural human response to chronic pain is to stop it. Selling does not always optimize financial outcome, but it often optimizes neurological relief, and relief feels like clarity, even when it is premature. There is another layer. Intelligence improves risk detection, but it also amplifies imagination. The more capable someone is at projecting possible futures, the more vividly they can imagine collapse. They do not just see falling prices, they see cascading defaults, liquidity freezes, systemic paralysis. The ability that helps them anticipate danger also accelerates psychological fatigue. Intelligence improves foresight. It does not improve endurance.
Behavioral economics draws a distinction between risk and uncertainty. Risk has measurable probability. Uncertainty does not. Crises are uncertainty. When probability disappears, the brain defaults toward worst-case interpretation. In March 2020, markets fell more than 30% within weeks. Many investors reduced exposure near the lows, not because they lacked experience, but because experience made the worst-case scenario more vivid. Experience can reduce surprise. It does not eliminate fear. There is a common phrase in markets: the market can remain irrational longer than you can remain solvent. Timing is not primarily a question of accuracy. It is a question of structure. An investor can be correct about overvaluation and still fail if markets extend higher for months. An investor can recognize panic and still fail if liquidity does not allow endurance. This is not a failure of intelligence. It is a failure of positioning.
Long-term data shows that missing only a handful of the best recovery days dramatically reduces multi-decade returns. And many of the strongest recovery days occur within weeks of the worst declines. The days of maximum fear often sit adjacent to the days of maximum rebound. To sell when it feels worst and re-enter before it improves requires precision within narrow windows during peak volatility. No model achieves that consistently. Markets are not governed only by logic. They are governed by incentives. Fund managers face quarterly scrutiny. Executives face career risk. In unstable environments, inaction appears irresponsible, so action is taken, sometimes prematurely. It is safer to fail conventionally than to succeed unconventionally. Time horizons compress, and compressed time horizons distort judgment.
Now we move deeper. In physics, entropy describes the natural drift of systems toward disorder. No villain required, only time. Financial markets are complex adaptive systems. When stress enters the system, entropy rises. Information becomes noisier. Rumors spread faster than data. Conviction fragments. In crisis, the fastest growing variable is not volatility alone. It is informational entropy. Signal weakens. Noise expands. And as entropy rises, cognitive fatigue rises with it. Most people assume time clarifies truth. In stable systems, sometimes it does. In unstable systems, time often increases distortion before resolution. Belief erodes gradually. Conviction decays. Narratives multiply. Eventually, decisions are made not because clarity has arrived, but because endurance has diminished.
Intelligent individuals rely on models. Models create structure. Structure creates the illusion of control. But entropy does not respect models. Complex systems do not resolve linearly. They oscillate. They overshoot. They revert. Analysis improves awareness. It does not slow time. It does not reduce chaos. In high entropy systems, prediction is fragile. Survival is durable. The investors who do not sell at the bottom are rarely the ones who predicted perfectly. They are the ones whose structure did not require precision. Low fixed obligations, limited leverage, liquidity sufficient to endure volatility. Markets do not reward those who are correct earliest. They reward those who remain present longest.
Crises are not events. They are processes. Processes unfold slower than fear anticipates, and faster than comfort allows. Intelligence improves detection of risk. It does not improve tolerance of time. Under pressure, selling early and being fundamentally wrong can look identical until time reveals the difference. And time is the one variable no participant controls. This is Under Pressure.